Ladies and gentlemen of the crypto space, we're live on a Friday, October 20th at 11:26 a.m. Not bad on time today. I just need to fix this for you guys. Pieces and puzzles. So the whole world has individual pieces of information, and there's a correlation between everything. There's a rhyme and a reason, and that puzzle, how those pieces fit together, was the same for about 40 something years, but that directionality, that trend, that puzzle is broken and everything is certainly changing. Now, I often say, especially when I encounter persons that have a capacity to absorb information much better than I, and sometimes even present information much better than I'm not the smartest person in the room by far, but what I'm good at is seeing the connections between things. Causality. I'm good at seeing correlation. I'm good at seeing analogy or inferring analogy. This is like this. This is like that. And that gives us a story to tell, thus why we've been telling stories for the last couple of years. And it's quite fascinating, the story and how it's changing. Now, what has broken most recently, or at least the last couple of days, is oil pushing towards 90 and the dollar basically going horizontal at 106. And especially with the move on yields yesterday and the day before, 10-year literally hit 5 and is retreated 100 basis points today. That's incredible volatility for the largest asset of the largest asset class on the planet. And usually the dollar is correlated. These two pieces of the puzzle make sense, but the last 2 days they don't. They're painting a different picture. It's a different puzzle. The dollar did not move up with the rise in long end yields. And that is a break of correlation. So change starts at the margins, meaning you could see this type of observation. You don't know if like directionality is going to start to become inversely correlated, but it's a possibility. And if it does, that has big implications, ramifications. And that's what I have my eyes on, especially today. I'm seeing the weakness of the dollar where it would be strong, in conditions where it would be strong. And I've obviously showed you guys this chart of the yearly on the dollar, and my sense is that it wants to reverse to the downside. And what does that mean, wants to reverse? The chart doesn't want to reverse, but the pressures in the system that cause the dollar to appreciate want to reverse. Obviously, they want it to reverse because a weaker dollar is what allows the system to continue. It allows for energy prices to remain decent without having to drive down the relative valuation of foreign fiat. And it allows debt to be serviceable in foreign fiat terms without it continuously getting more and more expensive. This appreciative cycle between 2008 and the end of last year has made debt servicing quite difficult, increasingly difficult, cycle after cycle. Now, this candle here on the yearly chart, a reversal would take years to play out. And that's quite interesting because, everyone screams or thinks and then screams. The whole BRICS thing was a big deal. Like the whole system is coming to an end. And history tells us systems don't come to an end promptly. The fall of Rome took 100 plus years. So there's no reason to make decisions and choices based on something occurring quickly. So sure, dollar endgame, Brent Johnson methodology, and that's very rational. There's a logic and a reason to it. It makes sense causally, cause and effect, and what causes pressures on what. And the death of the dollar, is it going to 2, 3, 4, 500, 1,000? but that does in no way indicate we can't have a 10, 15-year reversal of lower highs and lower lows on the dollar. Japan would surely like that at 149, pushing 150 to 1. They're at a critical threshold. So, you know, does the dollar can what do we know? We know that cycles will cycle, which means at some point the pressure reverses. And does it reverse because of organic phenomena? Does it reverse because of long-term demographic changes that are finally kicking in? Does it reverse because of geopolitical collusion? Does it reverse because literally behind the scenes, dollar do, systemic vested interest in the dollar, primarily Treasury and Fed, and just anyone who's interested in the U.S. economy from a regulatory standpoint, know that you have to devalue the dollar to some degree. And what does the value of the dollar mean? You literally have to provide dollars to the rest of the world. And for the last 15 years, they've been starving the rest of the world of dollars. And it just so happens that structurally the dollar is screaming, please weaken. And that's obviously from the perspective of countries around the world. And we're heading into 2024 with $11.5 to $13 trillion worth of sovereign debt refinancing to occur. So we're heading into a year where the rest of the world is saying, weaken the goddamn dollar. Otherwise, something's going to completely break from major economies. And it's just sad when things break from the smaller economies. Human tragedy is horrible. But from a major economy perspective, that brings the stability of large populations or the large financial centers or countries of the world, brings the stability into question. So 2024 is potentially the year of a dollar reversal. Japan would sure as hell like that. Japan is in a predicament with their currency. And this pressure, this upward pressure of the dollar, really encourages higher and higher yields because, as Luke Groman talks about, there's $7 and change trillion worth of U.S. government securities held as savings outside of the United States. So if your currency is getting weaker and you want to defend your currency, if you're a country, you sell your savings for dollars and use those dollars to buy your respective currency. So that means yields go up, the treasuries got sold, dollar comes down because it was used to purchase foreign fiat, but yields go up, and now we have the domestic fiscal issue. I think there's a lot of reason to obviously think things break, and the dollar keeps going higher, and then geopolitical conflict is screaming everywhere. But to me, you can't discount the potential for the reality that cycles will cycle. And the end game is like geopolitical war, dollar goes up, up, and up, and currencies are failing, and we have just, the post-apocalyptic scenarios everywhere. Do you bet on that? Is that what you're going to bet on? So, personally, I want the dollar to weaken. I want bonds to reverse and appreciate from a yield term perspective, 2.5%, let's say. And that's not the long end. That's not the short end. That's the long end. And that'll force the Fed funds rate to adjust. Now, maybe this takes 6 months. Maybe you're talking about like sometime in Q2 2024. And then the Fed's funds rate will have to adjust to account for, the real yield on debt. They really need it to be negative, and they can't afford positive, and positive just crushes the economy. So it's like they'll need to adjust accordingly as the market prices in the long end of the bond market. So next year, if the dollar reverses and collateral, the long end rallies, and they refinance 11.5 to 13 trillion, we're talking about the biggest. It'll probably be a bigger liquidity flood than 2020. because the euro dollar market is leveraged. You're not printing one to one. You're leveraging the shit out of everything, and everything gets rehypothecated 10 times over. So you're printing dollars outside of the U.S. with 11.5 to 13 trill worth of fresh on the run paper, and then the dollar's coming down, so all those printed dollars become more valuable. Lower highs, lower lows on the dollar, a rally in the bond market, and all that fresh on the run. This shit could get crazy next year, and I'm here for that. That's what I'm here for. That's the bottom line. Asmith in the house. Tapsy, yo. I quoted you to a family member who asked, should I sell at the top? And I said, okay. But then you have dollars. What are you going to do then? Now, bear in mind, selling the top means, buy Bitcoin now and sell it 100 grand. And that's great. And you sold at 100 grand, and it's like, this is what you have to do, contemplating that action, that activity. Then you have to wait 2 years, 3 years for Bitcoin to settle around 30, 40, 50 grand. And then you take that 100 grand, you buy it again, and then you sell Bitcoin at $250,000. And, all right, fine. 5, 6, 7 years later, then you have dollars again. And what, you have a couple of multiples, so you turn 10 grand into 70, 80, 100 grand, and you're stuck with dollars again. So that kind of time horizon is not palatable to me. To get a 10x, a 15x, and I can't subscribe to it. So the most important thing to always bring up when talking with folks is, what next? If you're having a conversation about like how to engage with markets, and they're like, oh, I want to buy low, sell high, then what? What next? And that should get either people thinking, hopefully, or just allow you an opportunity to describe more sophisticated ways to engage with markets. I'm just fond of the moderately wealthy and the ultra wealthy's mentality. It's like they don't want to be sitting in front of a screen. They're not day traders. I mean, maybe some of them are, but I don't want to be doing that kind of work. I don't want to do that work. I don't want to do work. I'll own a business, like a real meat space business, after I make money in the coming years, and that's not necessarily work. It's something I want to do. So I guess if trading is something you want to do and you don't think of it as work, but it's your passion, your activity, all right, great. To each their own. But for me, that's not the case. So I really subscribe to the moderately wealthy to the ultra wealthy's mentality, where you just own businesses and the businesses do the work. And the businesses are either corporations of people, and you have managers that are doing work for you. And that seems like a lot of risk because you're dependent on humans. And humans inherently have a massive risk factor. Reliability, dependability, consistency, predictability. You can't trust humans. As well as common denominator indicates you can't trust a human. So that's why I like software contracts, and I think software contract enterprise is the most fascinating thing heading into the 2030s. So you don't have to like jump into that as the destination for such a conversation. Like, what next? And all right, it's a complicated thing to digest. Just business, and from a traditional meat space perspective, how do you explain dividend investing to a person that doesn't have any investment experience, and then yet alone asset ownership, enterprise ownership? I guess that's understandably quite overwhelming for the majority. Gen pop. And that's not necessarily a bad thing, and it's understandable. But we can always encourage folks to do better. And that's why we're here talking about what we talk about. Dan's in the house. Kill us. Bill. Hey, Cap. Happy Friday. You've been keeping an eye on the SBF trial. What's your thoughts? What a waste of an opportunity. I mean, just call in accountants and get the books right. And my sense is he wanted to do well, but he was an idiot. And they did nothing professional. And did the wrong thing with people's money because they operated like a bank, but they didn't have the banking regulations applied to them because they were international jurisdiction. So it's like they do whatever they want. You can't operate a bank if you don't have banking regulations being applied to. There's a reason the banks are regulated as such because of all the risks, and they're regulated quite well to a degree, especially the GSIBs. The regional banks are in a conundrum, obviously, with their portfolio composition. But is that fraud? Yeah, you can't operate like a bank if you're not following the rules of a bank. So you can't commingle funds and misallocate funds. I mean, literally, what gets me so frustrated is it was a printer. It was literally a money printer. All you had to do was operate the balance sheet like a bank and seek professionals that know how to operate as like that and operate an exchange, and then all those people using the exchange, all those fees. It was literally just the money printer. What a shame. What a missed opportunity. Larson's in the house. A pleasure. Larson, any opinion on Y curve, SD curve, trying to think rationally with a smaller portfolio? I wouldn't really allocate to curve or curve ecosystem with a smaller portfolio. I don't think he gets the multiples that people want. Probably just like if I had a smaller portfolio, I don't know, Ethereum, Solana. You're going to get, once the liquidity cycle flows, Avalanche will run, obviously. And look what Phantom did. And Phantom has just completely collapsed. It's basically dead at this point. But who knows what happens if 500 billion worth of liquidity flow into the DeFi space. Things get wild again. Except now, so many more people have so much more experience. And so that could be a factor that reinvigorates a variety of networks and chains. Man, that degeneracy is going to be wild on Pulse Chain. I just don't have any trust for those bridges, or especially the peers. The vested interest, zero trust. So I just can't really engage with it. I have capital needs for next year, and I cannot accept that kind of risk profile for engaging with that network. And that's the case for many networks. There's one thing that I did play with for the fun of it, and that was Thorswap, because I've had a Cosmos bag for years, and it's been just compounding for years. But this month I decided to capitalize and take income. So this worked out well. I was quite surprised. It's the first time ever that I was able to swap native Atom to USDC on Ethereum mainnet. Not using a centralized exchange, using relatively the controversy of Thorchain, which is, I think it's quite reasonable. But it worked, and it worked quite well. And I was able to convert Atom to USDC, so that was nice. We still have that Iris position that we've had for all those years. A couple of other small things, primarily just Atom. And it was nice to be able to sell some of it. And I got my QuickBooks implementation all configured for income from Cosmos. Like, what? The QuickBooks was like, a new source of income? So that was cool. This worked well. There was an error in the transaction, and I talked to support on Discord, and it ultimately went through. So even though the user interface displayed an error, about an hour to hour and a half later, the transaction went through, and the transaction settled on Ethereum mainnet. So ultimately, it did work. So that was nice. This is, in my opinion, just another classical example of great tech. Great tech. I mean, it's not really an interesting investment at all to me. But clearly it's an interesting investment to many, which is why it still works, and it works quite well. Like trading of assets, it's just pure speculative. So I don't find that narrative interesting. But clearly, when degeneracy returns, people are going to be trading shit for shit, and especially cross-chain. Seamless cross-chain interoperability is going to be a big narrative. Talked about that at the end of 2021. So this is that type of tech. And I just want to focus on 2027, 2030, and that's why actual currencies, foreign fiat denominated currencies, foreign uh, debt denominated instruments, and who's going to operate those types of assets, and where are those deployers of those assets going to head. And that's why we talk about what we talk about. Uh, like Maverick, look at all the volume that's going to the protocol. Why? Because it's efficient, and it's going to get surfaced in 1 inch and all the routers. So it's going to get all that volume. So the race to the bottom with regard to transaction fees is there. To race to zero, transaction fees aren't going to garner money, and it's not going to earn money in the coming years. So it'll be interesting how you incentivize liquidity. And that's why it's not just the efficiency of a transaction that matters. It's how you incentivize liquidity depth that matters much more. And I think at some point, unless there's a federation that builds around MAV, it's the same concept with Solid. Unless a federation builds around MAV, this is just one direction, not the band, just one direction only, and straight down. Like, what's the point of buying it? I don't give a shit about buying anything to vote on something. The reason I give a shit about voting on things is because someone's going to pay me. So it's not really, it's not a pay for rental. We've struggled over the last couple of years to define the behavior and what it is from an enterprise perspective. It's not bribing. It's vote rentals. And it's not governance per se. Obviously, it's governance when you talk about deploying gauges and making modifications to the mutable characteristics of a protocol. But when it's with regard to emissions direction, that's it's not bribery. It's not vote rentals. I've been trying to think about this more, putting into an enterprise terminology. I probably continue to struggle with that, but I don't think it has the negative connotation that everyone thinks it has. You got to fold it into something using an analogy and describe the behavior and what is it at its most basic level. Because ultimately, third parties are financing liquidity depth. We have a capacity to, maybe it's like we're on the board, that's governance. So all right, that's a dead end real quick. But our income doesn't come from the protocol; it comes from third parties. Maybe it is bribery. What the hell do I know? So smaller protocols. You need the multiples. You need the capital. Larson. That's not an easy equation, and I don't think Curve's going to get the multiples, in my opinion. I have multiple expectations, as in how many multiples am I expecting for certain assets over the next 1 to 3 years. And for like Curve, if I see like a 5x from here and we're at $22.50 at the end of 2024, I'm like, yay! That's my expectation. Like when rampant degeneracy, if we get to $5 and it crashes to $2.50, I'm like, cool. So that doesn't do much for a $1, $2, $3, $4, $5, $10,000 portfolio, and that requires exactly what Tapsy talked about at the beginning comment. It was, all right, I'm going to sell the top. Not so easy to sell the top, and after you sell the top, you have dollars, and what the hell are you going to do with the dollars? You're going to wait 2 years for bottom. It's not so easy to buy the bottom, and then you buy the bottom, and it's not so easy to engage with that methodology. And trading's another story, and technicals and leverage. So I don't talk about that. I don't wish to encourage anyone to engage with that behavior because that's how you lose all your money. When you're playing with spot and you own assets, there's nothing to lose. When survivability is the characteristic that you've observed. If something that survives and becomes infrastructure, it's going to be volatile in price, but the infrastructure is going to be there. So you don't have a capacity to lose what you've invested your time and your capital in. It's just a volatile price and everything reinflates in the coming years. I feel like if I went straight V curve, the gas would kill me thinking other options. Yeah, the returns on base VE curve are like probably like 20-25%, give or take. And, you know, like 100 grand, that's pretty cool. Again, 25 grand a year. And that sounds decent. So smaller portfolios, you're not going to 5, 10, 15, 20% do nothing on smaller portfolios. You got 10 grand and again 25% and you could live off $2,500 a year, then that's considerable. 25% significantly above risk free, and that's a decent equation from a traditional dividend investor's mentality. But it was very dependent on geographical locale. It's very dependent on standard of living expectations, capital requirements, and what you want to achieve. What is the goal? What is your goal? Like the biggest issue when liquidity floods the system and people start speculating is they don't have a goal. I want to make money. Everyone wants to make money. You got to define what you want to do. What is your expectation? Because the worst thing you could do is not meet your expectation. Another worst thing you could do is to have irrational expectations. It's like, no, you're not going to achieve that. Or it's just open-ended expectations. Set a concrete expectation. Make sure it's reasonable. Like 5x on curve, and I'm like, all right, cool. That seems reasonable. It's significantly below all-time high. If you see 100, 200, 300 billion dollars flow in with regard to liquidity, it's like things are going to speculate. Velocity is going to go. Transaction volume is going to run up. That means the yields are going to run up, and the yields are going to attract activity. It's going to draw in capital flows, and the price will go up. So, that seems like a reasonable statement. It's not like 50x on curve, and curve goes to $30, and there's plenty of, all right, fine, those types of numbers can't happen, but that's not my expectation because I don't want to be disappointed. I need something that's reasonable. Larson, do you have a preferred one out of the two from a tokenomics perspective? Well, Stake DAO has pivoted significantly over the years and is much more established as compared to Yearn, but Yearn's products have recently become notably reinvigorated, especially with their Yearn Tokenomics that literally just deployed like yesterday. VE, whatever their token name is, I don't even remember at this point. I don't see much opportunity from a yield perspective on risk reward like Yearn versus Stake DAO, but 25% doesn't do much on a smaller portfolio. So I honestly would consider invalidating the entire idea of deploying to that ecosystem. I just don't think it works. You just need to. It's not easy to get a portfolio, a functional, a useful portfolio off the ground. It's the same equation for like real estate. It's like how do you, so many folks take on debt, and that's why we have these major corrections and defaults, especially with like the Airbnbs and stuff. It's because the small amount of capital doesn't work, and that's why so many uh, methodologies and opportunities are shilled to people. Oh, invest not using your money. Yeah, not using your money implies a liability, some sort of debt obligation. And there's a risk profile associated with that. So I'm like, I'm 40 years old. I don't want to take any goddamn risk. I don't want to take on any debt. I want to buy spot. I want to just own things. And I use my income from work. Actually, I don't. I haven't bought anything with income from work in years. It's just income from assets. I guess that could be defined as compounding, but I define it as income. Of which some of that income, especially over the last 2 years, has just flown out of the crypto space, and I've used it for the real world. I guess that's the goal that folks want to achieve, but don't set false expectations. If you can't do it, the hardest thing is to overcome that sense of disappointment. And I've encountered that sense endlessly over the years in my life. And there's no guarantee that disappointment will ever be alleviated. But there's one thing I say, and I've said it on Twitter: the measure of a person is their relentlessness. That's the strength of a person, is their unending need to alleviate disappointment. So part of that is like setting reasonable expectations. If you set a reasonable expectation and you achieve it, you're not going to be disappointed. And then you can maybe set a larger expectation and take a little bit more risk. But once you get into that positive feedback loop of setting a reasonable expectation, becoming satisfied and actually achieving it, then you could expand risk and expectations. But you got to start small. Maybe we leapt a little bit, maybe a little bit too far in 2020 and 2021. But there will be a time for leaping, and I think it's coming sooner than later. Like 2024 has leaping written all over it. Dan's in the house, and the few folks that have stuck with me over the years. Killis is in the house. And we'll have our 2020 moment to a degree. It's not going to be the same. It's going to be different, because it is different. It's not going to be different with regard to price action and volatility and degeneracy. That'll be the same. What type of degeneracy? The type of degeneracy might be different. Different things might be interesting. Capital might flow to different places. We're surely going to have a wild experience in 24, considering the cross-chain concept. I mean, end of 2021, it was like obvious, like cross-chain seamless liquidity. That's going to get crazy. Like other chains, there's going to be significantly more capital flow to other chains. ZK, other EVM compliant chains, and Avalanche. Can you imagine? We had fun when Aave first ported to Avalanche and Polygon. That was crazy. But now with seamless cross-chain, you're not using the bridges. You're using layer zero, like omni-chain assets, and Tapioca's coming online, and all these systems and protocols that facilitate, like, all right, you're on Cosmos. You have Atom on Cosmos Network and say, all right, I want USDC, pop it on a debit card. Or even the damn debit cards nowadays just take Atom. Or did you put stablecoins from Binance chain onto a debit card? And holy crap, you had nothing in 2020. There was nothing. There was no debit cards. There was barely any on-ramps and off-ramps. You were talking about using like Coinbase and Gemini to get capital on and off. And there's all infrastructure nowadays. Oh, it's all different. So the only thing that's missing with regard to opportunity is liquidity. And once liquidity comes in, it's going to be madhouse of activity, of millions of new people playing around with, how do I put capital in? How do I take capital out? How do I move capital from one chain to another? There's going to be billions of dollars flowing across these chains, because there is billions of dollars in this system now. And you know what there wasn't in 2020? Billions of dollars. It was nothing. It's a couple $1 million at the end of 2019. Different world. Killis, no, what do you think about Abracadabra's place next bull market? I have family with some Spell. I always had a high opinion of Spell. It just got crazy, degenerate, and obviously it didn't work out with regard to social media and Sifu and stuff like that. That just, once something negative takes over the narrative, it just implodes. I have a high opinion of Spell. I think it could do very well. It's one of the CDPs. It's a well-known stablecoin. How does it do compared to Go? How does it do compared to Frax? How does it do compared to CRVUSD? How does it do compared to SDI? And now SFrax? I don't know. What I know is they have a capacity, the potential to offer products. And what I know is if there's just a flush of liquidity, everyone's going to use everything. So I think there's all the reason, and they have great tokenomics. Their get paid in MIM is really cool. So they do have an edge in that regard, and they do have an edge with regard to their presentation. Abracadabra, magic internet money. That's really cool. And that will certainly attract a certain type of market actor. I mean, it's not going to attract the banks. I mean, Maker will attract the banks, and Frax will attract the banks, and CRV Curve ecosystem and CRV USD could attract very different people, very different actors, and each one will attract different behavior. But who's going to attract the degeneracy? Abracadabra. So it's seamless cross chain too with Abracadabra. Didn't they do omni chain tokens? So different world with the bridges. There's no more bridges. Now it's just omni chain and seamless cross chain. And I mean, look at this. This Thorswap is interesting. Great product. Um, about 70K curve is what I'm referring to. 70K, 30 grand, give or take, right about now. I mean, listen, it's an interesting threshold. Let's say you get a 5x and 30 grand turns into like 150. 150 grand yields settle around 10, 15, 20%. Let's take the high end, 20%. 130 grand, 20%, $25,000 a year in income. All right. Measure that. Use those numbers and measure what your expectations are. If the potential for 25 grand a year in extra income in the next by 2030, extend the time frame to make it something reasonable and account for the volatility, and you have no idea what's going to happen between now and then. But let's say in 2030 you're pulling in greater than 25 grand in extra money a year, which relative to the capital now is like 80%, because you have to account for the appreciation of the principal and the potential for the yield to actually remain high, the Z component of X, Y, and Z. And let's say it does. I mean, that is quite meaningful. Now, age is a factor. Like if you're 18 or in your early 20s, what the hell is 10 years? I mean, I say that easily coming from a 40-year-old guy, but when you could burn 10 years and just come back and you have a fully functional revenue stream, an extra 20, 30, 40, 50 grand a year, that's a pretty cool way to start off your 30s. Time does the work. Time does the work. Killis, I know you don't trade on Pulse, but I wondered if you're familiar with SparkSwap. People are some big shots, I think. I forget the details. I don't know what SparkSwap is. Is it a Pulse DeFi AMM? There is no big shots. The liquidity on Pulse is non-existent. There's nothing. This isn't liquidity. That's PLS, WPLS. Where's the stablecoins? So the point is, the most important thing to inspect the network is the amount of stablecoins on a network. And I don't know if DeFi Llama has stablecoins to track on the network. Stables overview. Nothing but stablecoins matter, because that's all you're here to do is attract stablecoins, because that's how you make payment for things. It's the settlement currency, and stablecoins you can get into a form that you could pay for shit at CVS and a supermarket, Publix for me. So that's the most important thing to assess a network and the potential on a network. If 100% of everything is sold on a network, it's sold for literally the amount of stablecoins on the network. There's no other value. So scratch that one off. I mean, you could literally scratch off here's 16 mil. So cut that in half, because it's it's obviously a pair. So DAI, USDC, 6 mil, 3 mil, so 8 is like 10 mil. I mean, look, everything else is a mil, like 10 mil. It's like 10 mil. It's some tiny baby chain, and the heck of a risk exposure going through those bridges. They're just not something that's attractive. Look at the volatility. But who's your peers? I can't contemplate being active on a chain like this because of the peers. You need some sense of stability, reliability. You have to get into the mind of the peers, otherwise, how you engage in the market. And obviously, if we're in this kind of market, macroeconomic market, this market, anyone who's got to account for $10 million in there is very degenerate. It's pure gambling in a very volatile macro market. Big 14,000% on $578 worth of liquidity. It's nothing. Look at all the volatility. The big volatility is in stuff with zero liquidity. Zero. I mean, you got to literally gamble $20,000, $30,000 in a $145,000 LP position with a fully diluted value of $27 million. No, you can't do that. That's how you lose everything. FOMO buying investigators. It's literally just a token. You can spin up a token using in like 5 minutes, and then all it is marketing. Zeppelin, and it's very easy to spin up a token. Please be careful with this stuff. There's nothing here. There's nothing here that's significant or potential. There's no potential. There's nothing of substance. I want the money where a bank is going to go and deposit $1 billion of different currency pairs, and it's going to have $50 million worth of volume per day. And how could I get 0.0123% of that those transaction fees? And that's what I want. Joe, it's different this time? Yeah, very much it's different this time. Well, there's plenty of things that are the same also. The price action, the volatility are the same, but it's different. It is different. For the last 40 years, we broke down against the 1-year time-weighted average price on 10-year bonds, and this is yield. Broke down on yield, and it was lower lows and lower highs for 40 years. So this breach structurally, yes, there is no ambiguity here. It is different this time. Economists are finding a lot of different ways to say that. No, and I say it in one image. Structurally, there is no way to say it any other way. It is different. So the behavior of things are quite extraordinary. Look at all the stimulus. And what is a stimulus? The reverse repo market. What was it, like $500, $600, $700 million per day of liquidity is printed at the Fed to pay interest in order to remove $1 trillion out of circulation, whatever the hell the RRP is at right now. So they're paying a couple $100 million a day to remove $1.114 trillion of liquidity out of the system, and they're doing that obviously to control the amount of capital that could chase goods and services that control consumer price inflation. They drain the liquidity. They're financing the draining of liquidity from the system, and clearly this has come down from like $2.3 trillion, and that flooded the short end or wherever hell it's heading, because clearly that's come down and yields have gone up, and right now Treasury is having a difficult time finding buyers. Maybe this is their expected path, and they're expecting 5.5%, 6, 7% on 10-year bonds. This is pretty unprecedented of a directionality reversal. It's 41-year directionality reversal, an invalidation of trend. When structure breaks, it doesn't unbreak. These things take decades, especially secular trends that are over a 40-year time frame. I mean, it's different this time. This is the TLT. It collapsed. This is unambiguously economists are having a lot of different ways of saying it, but pictorially in chart form, it is very different this time. Unambiguous, baby. What do you make of steep correction? It's an inversion, and it's a bear steepener. So everyone, at least the classical economists, are looking for risk off in equities markets. How do you get the long end Who buys the bag? And with rates this high, as I've talked about, it invalidates the investment thesis for equities markets, especially growth. Growth is dead with these kinds of rates, especially if rates are going to keep going up. Growth is even deader. So what happens when you see no growth in equities prices because earnings are starting to forecast significant contraction? They're like, all right, capital flight directly to 5.28% guaranteed risk free for 20 years. So that's the whole crowding out concept. Who's going to buy a corporate bond at 5%, 6%, 7%, 8%? Nobody's going to buy a corporate bond at those percentages. You're going to get 3% over risk free, taking on the potential volatility of a corporation, the subjectivity of a human board, all the uncertainty associated with economic conditions, growth, sales, revenue. Oh my God. Talk about that's a risk premium, 3%? No. All right, fine, 10%. Well, you're getting into interesting risk premiums, but you still got the volatility and the uncertainty associated with the underlying principle. So the whole equation of what it means to be investable is changing. In that regard, it is different this time quantitatively. Is it not different where the biggest bear steepener in history sucks the capital out of the equities market? I would say probably it's not going to be different. Uh, there's actually potential that it is different. Now, bear in mind, price range. This is the S&P, the bellwether. You literally have a 20% correction in the S&P, and you didn't even break the time-weighted average price on the 6-month. On the yearly chart, you could literally have a 40% flash crash in the S&P, and it's not even bearish. It's just a mean regression. You buy it. You start seeing, if you want capital gains, you could buy that. You see Fed intervention, government intervention, stimulus, and all the stupid stuff, and you're at 2,500 on the S&P, and all the interventions coming, and everyone, all the corporations are getting bailed out. You buy that. Not that I would, I'm saying, but that's a buy condition. Why? Because at 2,500, you're not even below the damn time weighted average price on the yearly chart. Now, RSP is more equal weighted, has more bearish presentation because the stock market has already crashed. It's only the big corporations that didn't have to take on debt that are in a good position. But all the smaller, the mid caps, and the smaller large caps, they've been completely annihilated. Everything has completely mean regressed. Everything has completely mean regressed, except Apple and Microsoft and Nvidia and just stuff where all the cap. That's exactly why they've restructured the S&P to be like 30 something percent, like the Magnificent Seven or whatever, because it's a catastrophe what the broader equities market looks like. Hmm. Maybe a higher low on curve. Pull up the Stoke, pull up the RSI, might have a bullish divergence. Surely has a nice floor around 30, 40 cents. Look at that. 1, 2, 3, 4, 5. Just this whole region down here above 30 cents. Looks pretty good to me. Um, in terms of flight to safety, other than bonds, what do you think? Bitcoin and gold? Um, Flight to safety with regard to savings. So you work 10 years of your life, you have X amount of dollars, and you want to make sure your $10,000 is worth $10,000 in 5, 10 years. Oof, that's pretty disappointing if that is the case, because $10,000 doesn't go so far, and obviously the $10,000 in 10 years will be worth like what 100 grand, but it still buys what $10,000 buys today. So it's protecting against consumer price inflation and all the volatility in the various markets. So I don't want to correlate with the structural increase or debasement of currency. I don't want to keep pace. That's like looking at S&P divided by M2. Keeping pace doesn't get you anywhere. So the only way to outperform, Bitcoin should outperform to a degree, but it's cyclical because it outperforms and it underperforms. You have the 30-40% corrections, which are quite extraordinary. Gold should keep pace, but it's also suppressed significantly with the futures market. And it's what Willy Woo argued recently with Bitcoin as well. There's unlimited sell pressure and very limited buy pressure, which is quite an interesting observation on his part, and I appreciate it. Structurally, Bitcoin looks really good. 29,500. It's a breakout and a retest at the time-weighted average price. Breakout, retest, and all you need is the higher high. You get to $32,000, and I think the market is going to start telling a different story, because that's literally the trifecta of bullish confluence. Breakout, retest, higher high. And it's the same structure with Ethereum, more or less on the time-weighted average price, and there's 11 days left for hopefully a close, not necessarily in the green, but at least above the time-weighted average price. But structurally, it's basically the same. Breakout, retest, and a higher high would paint the exact same picture. Anywho. Okay, thank you all for joining. It's a Friday. I look forward to sleeping and out of waking up early and maybe get some sun this weekend, hit the beach. I encourage everyone to try and relax, and I know the date is crazy, but there's nothing you can do. You know, the longer time horizons force us to not consider the short terms. Stuff happens, Monday through Friday, but it doesn't really mean shit on a 6-month candle, and you have to let time pass. So we have to find peace with time. And then we got time to do the work. 14 people made it to the end of the stream. 10 likes. I appreciate each and every one of you. I wish you all a good weekend. Tell everyone to subscribe. Link in the description to the most rational community in the entire crypto space. I appreciate everyone in there. And next year is going to be fun. Just got to let the time pass between now and next year. See you again next